clearly the future of financial markets will depend on Donald Trump's success in sparking significant economic growth in the US. But that could also affect the future of interest rates. Ed Boyd caught up with GSFM market strategist Stephen Miller earlier today.
Oh, I think that's right, but I think what we're seeing is the stock market go on a bit of a rollercoaster ride today, and perhaps that's a harbinger of what we might see under this administration. I think there's a few challenges the President faces, particularly in relation to the budget deficit, maybe a bit on inflation, given in his pronouncements on tariffs and immigration and what have you. So that might mean higher bond yields, which will be a headwind to equity markets, but certainly the deregulatory agenda, the tax cuts, some of these structural currents that equity analysts are talking about, such as AI, will all act to sort of, I think, push the equity market higher. The only question mark, as I say, is those higher bond yields. Will they inhibit that movement higher?
Well, yeah, we saw a bit of a dip in the stock market today after Trump said he would potentially introduce 25% tariffs on Mexico and Canada on the 1st of February. Do you think he'll slowly introduce tariffs across other nations as time goes on?
Look, Donald Trump's a mercurial president, we know that, and what he often says and what he often does aren't quite the same thing. But an announcement that there's going to be 25% tariffs on Mexico and Canada come February the 1st, that's a pretty concrete, firm step, and that'll ignite those sorts of inflation fears, it'll ignite those bond yield fears, and it might mean that his agenda is broader than just Canada and Mexico and may relate specifically to China and beyond China to the EU as well. So, you know, if we take him at his word, then, you know, there's a bit for markets to digest in terms of higher bond yields and higher inflation. But as I said, those structural currents too are just as important in terms of a tailwind.
Yeah, how much of a concern are those higher bond yields with the US government's high level of debt to GDP ratio as well?
Well, I think they are. You know, the US has got a budget deficit of 6% of GDP and it's pretty close to full employment. And the way that deficit is funded is by issuing bonds. And when you've got a big supply of bonds coming onto the market, you've got to ask for higher yields or lower prices in order to effect that funding. And I think that's one of the bigger risks that's out there for the market, is the fact that bond investors are going to have to digest all this large amount of bond issuance, and they might only do so if you offer them higher yields in order to do so, which pushes up borrowing costs and makes it harder for equity markets, notwithstanding those other positive tailwinds that exist in terms of equity markets in the US.
And where does it leave the US Federal Reserve as well? I note Jerome Powell's chair position finishes in May 2026.
Yep. I think we've seen the Fed recently be a little more circumspect in terms of what they're going to do in regards future easing of policy rates. Now, the Fed meets at the end of this month. I fully expect that they'll leave rates unchanged, and I don't think they'll commit, certainly not commit in any concrete way, to taking rates lower at the follow-up meeting. Having said that, markets are saying, well, you know, the Fed will probably cut rates one, maybe two times this year. I think at the moment that's a pretty fair expectation. But, you know, it's going to be a volatile environment. One thing we'll know about a Trump administration is there won't be lack of news. There'll be a lot of volatility in financial markets, and volatility to some people means a lot of opportunity as well.
And Powell, for his legacy, he won't want to be known as the head of the US Federal Reserve that didn't bring inflation down quickly enough for American citizens.
I think that's true. I think, and that's why I think we're seeing the Fed be a little bit more circumspect with respect to taking rates lower. And I think they're going to sort of wait and see, or wait and assess what the inflation impact of things like tariffs will be, what the inflation impact of things like a more restrictive approach to immigration might be. That also, inflation has already proved stickier than I think markets were already anticipating. And I think Chairman Powell saying, OK, you know, we've made an opening gambit in terms of cutting rates, but let's just cool it. Let's wait for some water to pass under the bridge so we're in a better position to assess where inflation's going, because at the moment, as I say, it's looking stickier than I think the Fed thought it would be looking when it first eased rates back in September.
Stephen Miller from GSFM, thanks so much for your time.
No, pleasure. Thank you, Ed.